The semiconductor market has reached the point where normal adjectives are beginning to look underqualified. World Semiconductor Trade Statistics says global chip sales reached roughly $795.6 billion in 2025. Its spring 2026 forecast now puts the 2026 market at $1.51 trillion, an increase of about 90%. Memory alone is forecast to grow by roughly 250% and exceed $800 billion. Logic is expected to grow 37%. Microprocessors, 20%. Analog, 10%. Discrete chips, 8%. Sensors and optoelectronics, only 3%. Meanwhile, the Semiconductor Industry Association reported $120.6 billion of global sales in May 2026 on its 3-month moving average basis. That was 9.2% above April, 104.1% above May 2025, and the 15th consecutive month of sequential growth. At this point, the word cycle arrives in business casual. Supercycle walks in wearing a cape. But before we order the cape in every color, look inside the number. This is not one industry moving together. It is one market containing two very different economies. So the useful question is not simply, has the semiconductor supercycle arrived? The useful questions are, where has it arrived, why is it different from previous cycles, and what would tell us that it is ending? A normal semiconductor cycle is familiar. Demand rises. Inventories fall. Factory utilization improves. Prices recover. Suppliers add capacity. Then supply catches demand, inventories rebuild, prices weaken, and every earnings call suddenly discovers the phrase capital discipline. A supercycle is larger and more persistent. It changes product architecture, capital spending, manufacturing priorities, qualification schedules, and the distribution of profit across the value chain. It forces companies to make multi-year decisions before the next quarter has finished arguing with the last one. The current expansion passes several of those tests. AI systems require leading-edge logic, high-bandwidth memory, advanced packaging, test capacity, high-speed networking, power delivery, and cooling. A shortage in one layer can reduce the value of capacity in every other layer. 10,000 expensive accelerators without enough memory bandwidth are not a supercomputer. They are an extremely costly collection of space heaters. There is also a measurement trap. Semiconductor market size is measured in revenue. Revenue equals units multiplied by average selling price and product mix. If customers buy more HBM, larger accelerator packages, advanced node logic, and more expensive packaging, revenue can grow much faster than the number of chips shipped. The boom is real. But it is not simply more chips. It is much more semiconductor value inside each AI system. The 2021 shortage was broad. Global semiconductor sales reached $555.9 billion, up 26.2%, and the industry shipped a record 1.15 trillion units. Demand surged across PCs, cloud infrastructure, consumer electronics, vehicles, and industrial products. Supply chains were disrupted, customers double-ordered, and lead times became a competitive sport. That cycle was about many end markets demanding many kinds of chips at the same time. When demand normalized and inventories corrected, the breadth that had amplified the boom also amplified the slowdown. Classic memory cycles are narrower and easier to describe. Demand improves, bit supply is constrained, pricing rises, margins expand, producers add capacity, and eventually the industry discovers that memory can, in fact, remember overinvestment. The 2026 cycle is different in two ways. It is more concentrated than 2021, because AI-related memory and logic dominate the growth. And it is more architectural than a classic memory upcycle, because the bottlenecks are linked. HBM must be qualified with accelerators. Advanced packaging must connect logic and memory. Tests must validate increasingly complex devices. Data centers must provide networking, power, and cooling. The product is no longer just a chip. The product is a functioning system. Company results reveal where the profit pool is accumulating. TSMC reported second quarter 2026 revenue of $40.20 billion, with a gross margin of 67.7% and an operating margin of 60.3%. It guided third quarter revenue to between $44.6 and $45.8 billion. Micron reported fiscal third quarter revenue of $41.46 billion, compared with $23.86 billion in the prior quarter and $9.30 billion 1 year earlier. Its GAAP gross margin reached 84.6%. It guided the next quarter to $50 billion, plus or minus $1 billion, with gross margin around 86%. Micron also said HBM4 was in high-volume shipment for its lead customer's platform. Those are not normal cycle numbers. They are what happens when volume, pricing, product mix, and qualified scarcity all move in the same direction. In finance, that is called operating leverage. In plain English, it is called the spreadsheet has stopped behaving normally. ASML reported €9.3 billion of second quarter sales and a 54% gross margin. It raised its 2026 sales outlook to between €43 and €45 billion. It also plans to add roughly 30% to its 2026 low-NA EUV and DUV immersion capacity for 2027, while investigating another increase for 2028. Semi forecasts total semiconductor manufacturing equipment sales of $165.9 billion in 2026, up 23.2%. It expects test equipment to grow 31%, DRAM equipment 39%, and NAND equipment about 31%. Demand is not only producing current revenue. It is changing future capacity. That is one reason this cycle may last longer than a simple inventory restocking phase. It is also the reason investors must eventually worry about oversupply. Every supercycle contains the blueprints for its own correction. First, demand is being created by a new computing architecture. Traditional servers could add CPUs and ordinary memory incrementally. AI clusters require accelerators, HBM, advanced packaging, high-speed networking, and enormous power density as a coordinated system. The semiconductor content per deployed system rises dramatically. Second, the bottlenecks are qualification bound. A customer cannot replace an advanced HBM stack or packaging process as casually as changing a cable. Products must meet performance, yield, thermal, reliability, and platform requirements. Qualification protects suppliers, but it also slows the supply response. Third, packaging and test have moved from the back of the presentation to the front of the economics. When chiplets, HBM stacks, interposers, substrates, and thermal solutions interact, packaging is not decorative wrapping. It is system engineering. The back end has discovered that it was standing near the cash register all along. TSMC's packaging roadmap shows the scale of this transition. The company says its current CoWoS capability supports a package size of about 5.5 reticles. It plans roughly 14 reticle capability in 2028, enabling configurations with around 10 compute dies and 20 HBM stacks. That is not a slightly larger chip. It is a small neighborhood with a thermal management problem. Fourth, infrastructure outside the chip matters more. A data center may have accelerator demand and still be delayed by transformers, grid connections, cooling systems, construction, or networking. Semiconductor demand can remain strong while physical deployment moves unevenly. The silicon may be ready before the building is. Fifth, the cycle is geopolitically duplicated. Governments and companies are building regional capacity for resilience and security. Duplication supports equipment demand, but it can also create capacity that is economically less efficient. Strategic redundancy is still redundancy, even when it arrives with a ribbon-cutting ceremony. The aggregate market can reach supercycle scale, while many semiconductor companies experience only an ordinary recovery. Analog, discrete, sensor, automotive, industrial, and mature node businesses do not automatically inherit HBM economics. Their demand cycles, inventories, pricing, utilization, and competitive structures are different. A generic, semiconductor bullish thesis is therefore too broad. The correct unit of analysis is the bottleneck. Does the company control scarce, qualified capacity? Does it possess process or product differentiation? Can it convert demand into price, mix, margin, and cash flow? How quickly can competitors add supply? How much capital is required? What happens when the bottleneck moves? A company can report strong revenue and still destroy value if it buys peak cycle capacity at the wrong cost. Conversely, a company with slower current growth may become strategically important if the system bottleneck moves toward its product. The market headline tells you the size of the river. It does not tell you who owns the bridge. The cycle can remain strong while three conditions hold. AI infrastructure spending must continue expanding. Qualified supply in critical layers must remain constrained relative to demand, and the profit pool must continue converting into cash flow rather than disappearing into uncontrolled capital expenditure. The main durability mechanism is not merely shortage. It is the combination of high technical barriers, long qualification cycles, difficult yield ramps, and system-level demand growth. But the reversal mechanism is equally clear. Capacity is expanding across memory, advanced logic, lithography, packaging, and test. Supply responds slowly until it does not. The risk window appears when new capacity arrives at the same time that AI spending growth slows, customers digest inventory, or system deployment is delayed by power and infrastructure. That is when a structural shortage can discover that it still has a cyclical personality. Signal 1. Memory pricing and HBM contract terms weaken even while announced AI demand remains strong. That would suggest supply is catching demand faster than expected. Signal 2. Cloud and hyperscale capital expenditure growth slows, or companies shift from building capacity to improving utilization. Efficiency is healthy for customers, but it can be unfriendly to suppliers selling the next wave of hardware. Signal 3. Lead times, utilization, and gross margins fall together across advanced memory, foundry, packaging, and test. One weak data point is noise. A synchronized decline is a message. Signal 4. Equipment orders and capacity plans continue rising while end demand estimates stop rising. That is tomorrow's oversupply wearing today's optimism. Signal 5. The profit pool broadens in the wrong way. If low-barrier suppliers add capacity quickly and pricing power disappears, revenue may still grow while returns fall. The cycle does not end when headlines become less exciting. It ends when scarcity, qualification power, and financial conversion weaken. So, has the semiconductor supercycle arrived? Yes, but not as a universal industry boom. The evidence supports a bifurcated AI infrastructure supercycle, extraordinary growth and profitability in advanced memory, leading-edge logic, advanced packaging, test, and the equipment supporting them, alongside much slower conditions in several traditional categories. This time is different because semiconductor value is rising at the system level. AI architecture requires more expensive and more tightly coupled components, while qualification and infrastructure constraints slow the supply response. But different does not mean immune. The same forces extending the cycle, high margins, strategic investment, and urgent capacity expansion are also financing the eventual correction. For investors, the winning question is not, are semiconductors going up? It is, where is the bottleneck? How durable is the qualification barrier? How efficiently does scarcity become profit? And what evidence would prove that the bottleneck has moved? Because in semiconductors, the party usually ends before the factory expansion presentation does. This video is for research and education. It is not personalized investment advice.